A central bank's main objectives are usually price stability, low predictable inflation, full employment, and sometimes financial system stability. Think of the bank as a thermostat for the economy. The policy stance is the setting of the thermostat: expansionary warm when growth is weak, contractionary cool when inflation is too high. The transmission mechanism is how that thermostat setting reaches households and firms. Interest rate channel. A lower policy rate reduces market rates, making loans cheaper, encouraging borrowing and spending. Exchange rate channel. Lower rates can depreciate the domestic currency, making exports cheaper and imports pricier, which raises net exports. Wealth channel. Lower rates boost asset prices, stocks, houses, increasing household wealth and consumption. Expectations channel. The announcement of a policy stance shapes what people think will happen to prices and output, influencing their current decisions. An easy-to-understand analogy. If a school principal says we will give extra credit next month, students' agents start studying now even before the extra credit is actually handed out. The same logic works for monetary policy expectations. The traditional tools a central bank uses are open market operations, OMO, buying or selling government securities in the open market. When the bank buys bonds, it pays cash to banks, increasing reserves and pushing down short-term rates, expansionary. When it sells bonds, reserves fall and rates rise, contractionary. Think of OMO as a faucet. Turning it on adds water liquidity to the system, turning it off drains water. Discount rate or policy rate, the interest rate the central bank charges commercial banks for short-term loans, the discount window. A lower discount rate makes borrowing from the central bank cheap, encouraging banks to lend more. Reserve requirements, RR, the fraction of deposits banks must hold as non-lending reserves. If RR is lowered, banks can lend a larger share of their deposits. Money multiplier, M equals 1 divided by RR. Money supply, M equals M times base money, B. If RR equals 10%, 0.10, the multiplier is 10, meaning each dollar of base money could support up to $10 of total money. However, in practice, the actual multiplier is lower because banks hold excess reserves and people hold cash. Real-world example. In 2008, the Fed lowered reserve requirements to near zero, effectively removing this constraint and allowing banks to create money mainly through OMO and other tools. Explanation. The Taylor rule provides a simple way to set the short-term policy rate I based on the state of inflation and output. It was derived by John Taylor 1993 to capture what many central banks do in practice. Derivation simplified. Start with the idea that the policy rate should respond to the gap between actual inflation pi and the target inflation pi star, and to the gap between actual output y and potential output y star. Assign weights, often 0.5 to each gap. The rule becomes I equals r star plus pi plus half of pi minus pi star plus half of y minus y star. R star equals equilibrium real interest rate, often assumed around 2%. Pi equals current inflation rate. Pi star equals inflation target, for example 2%. Y minus y star equals output gap, expressed in percent of potential GDP. Application example. Suppose R star equals 2%, pi equals 3%, pi star equals 2%, and the output gap is plus 1%, economy is 1% above potential. Plugging in. I equals 2% plus 3% plus half of 3% minus 2% plus half of 1%. Equals 5% plus half of 1% plus half of 1%. Equals 5% plus 0.5% plus 0.5% equals 6%. The rule would suggest a policy rate of 6%. If inflation falls to 1.5% with the same output gap, the calculated rate would be lower, showing how the rule automatically eases policy when inflation is below target. The Taylor rule is not a law, it is a guideline. Central banks may deviate because of financial stability concerns, credibility issues, or zero lower bound constraints. The ISLM model captures the goods market IS curve and the money market LM curve in a closed economy. The ADA-S model shows aggregate demand, a D, and aggregate supply, a S, in price-output space. Both can be used to see the effect of an interest rate change. Step-by-step calculation ISLM : IS curve, y equals c of y minus t plus I of I plus g plus nx of EYY star, where nx depends on the real exchange rate E. LM curve, m over p equals L of y and I with a given money supply m. A lower I raises money demand L, moving the LM curve up or right depending on the formulation. Equilibrium solves the two equations simultaneously. Example numbers : consumption function, c equals 0.6 of y minus t. Investment, I equals 200 minus 50i. Government, g equals 150, taxes, t equals 100. Money market, m over p equals 0.5 y minus 100i, with m over p equals 500. Solve IS, y equals 0.6 of y minus 100, plus 200 minus 50i plus 150 plus nx, assume nx equals 0. This simplifies to y equals 0.6 y minus 60 plus 200 minus 50i plus 150, which gives 0.4 y equals 290 minus 50i, so y equals 725 minus 125i. LM, 500 equals 0.5 y minus 100i, which gives 0.5 y equals 500 plus 100i, so y equals 1000 plus 200i. Set IS equal to LM. 725 minus 125i equals 1000 plus 200i, which gives 325 equals 325i, so I equals 1%. Plug back. Y equals 725 minus 125 times 0.01, approximately 723.75, about 724. If the central bank cuts I to 0.5%, repeat the algebra and you will get a higher Y, about 762, illustrating expansion. A DAS perspective : a D is derived from the ISLM equilibrium. A D equals Y of I lower I shifts a D right. Short run an SRAS is upward sloping. P equals PE plus alpha of Y minus YP. The intersection gives the new price level and output. A modest I cut raises Y, and because the short run S is not perfectly flat, raises P a bit, representing mild inflationary pressure. These calculations help MBA students see the numeric impact of policy moves, not just the qualitative direction. Many central banks now target inflation explicitly, for example 2% in the United States Eurozone. The idea is to anchor people's expectations so that actual inflation stays close to the target. Expectations management works like a public speaking coach. If the coach repeatedly says you will speak confidently tomorrow, the speaker internalizes that and actually feels more confident. Similarly, when the central bank consistently says we aim for 2% inflation, households and firms set their price-setting behavior around that number. The new Keynesian Phillips curve, abbreviated NKPC, formalizes the link between inflation, expectations, and economic slack. Pi sub t equals beta E sub t of pi sub t plus 1 plus kappa open parenthesis, y sub t minus y star sub t close parenthesis plus epsilon sub t. Pi sub t is current inflation. E sub t of pi sub t plus 1 is expected inflation next period forward-looking expectations. Y sub t minus y star sub t is the output gap measure of slack. Beta 0 less than beta less than 1 captures how much future expectations matter today. Kappa greater than 0 measures the sensitivity of inflation to the gap. Epsilon sub t is a cost push shock, for example oil price. Key insights. Expectations matter. If people expect higher future inflation, today's inflation rises even with little slack. Policy credibility lowers the beta term because credible policy makes expectations stable. Targeting works by influencing E sub t of pi sub t plus 1 directly. A firm commitment reduces the need for large output gaps to achieve the target. Real-world example. When the Bank of England announced a 2% target in 2003, inflation volatility fell, illustrating the power of clear expectations. Policy implication. Central banks should communicate clearly, such as press releases, minutes, speeches, to shape E sub t of pi sub t plus 1. When the policy rate hits the zero lower bound, traditional tools lose potency, so central banks resort to unconventional measures. Quantitative easing (QE). The central bank buys long-term government bonds and sometimes corporate securities directly from the market. The balance sheet expands, injecting reserves and lowering long-term yields. Analogy: if a river's flow short-term rates is blocked by a dam zero lower bound, QE opens a side channel that lets water liquidity flow downstream to irrigate farms' long-term borrowing. Forward guidance: the central bank promises to keep rates low for a certain period, or until specific economic conditions are met. This shapes expectations of future rates, influencing long-term yields even without immediate balance sheet actions. Balance sheet modeling: to analyze QE, we can write the central bank's balance sheet as assets equals liabilities plus QE bonds BQE equals base money M plus other assets gold FX equals reserves of commercial banks R. When the bank purchases delta BQE bonds, it credits the seller's bank reserve account by the same amount, increasing M and R. Example: the Federal Reserve's QE1 bought $1.25 trillion of Treasury and MBS securities, expanding its balance sheet from $0.9 trillion to over $2.2 trillion, which helped push the 10-year Treasury yield from about 4% to below 3%. Unconventional tools are essentially communication plus portfolio rebalancing mechanisms that influence both expectations and the term structure of interest rates. In an open economy, the Mundell-Fleming model, abbreviated MF, extends IS-LM by adding the foreign exchange market and capital mobility. The key equations are: goods market IS star, y equals C of y minus T plus I of I plus G plus NX of EYY star, where NX depends on the real exchange rate E. Money market LM star, M over P equals L of Y and I. Interest parity condition: perfect capital mobility. I equals I star plus expected change in E divided by E, where I star is the world rate and expected change in E divided by E is the expected depreciation. Policy under fixed exchange rate: the central bank must intervene to keep E constant. If it tries to change I, for example by open market operations, capital flows offset the move, forcing the bank to buy or sell foreign reserves. Hence, monetary policy is ineffective. Fiscal policy, a shift in G, works. Policy under flexible exchange rate: the exchange rate floats. An expansionary monetary policy lowers I, causing capital outflow, which depreciates E. Depreciation improves net exports, amplifying the initial IS shift. Monetary policy becomes potent. Numerical illustration: assume I star equals 2% the world rate. Initial domestic I equals 2%, peg Y equals 100. Central bank conducts an open market operation to increase M, lowering I to 1.5%. Interest parity: 1.5 equals 2 plus expected depreciation, which gives expected depreciation of negative 0.5%, meaning the domestic currency is expected to appreciate. Under a fixed peg, the central bank must sell foreign reserves to keep E unchanged, pushing I back to 2%, policy neutralized. Under a floating regime, the currency depreciates by approximately 0.5%, improving net exports and raising Y. Thus, the Mundell-Fleming model shows that the choice of exchange rate regime determines whether monetary policy can influence output. Fiscal and monetary policies interact through the government budget identity and the debt dynamics equation. Debt dynamics in per capita or ratio to GDP terms. B sub t plus 1 over y sub t plus 1 equals 1 plus r sub t, b sub t divided by 1 plus g sub t, y sub t minus primary surplus sub t over y sub t plus 1. B equals nominal government debt. R equals effective interest rate on debt, influenced by monetary policy. G equals nominal GDP growth rate. Primary surplus equals taxes minus non-interest spending. Rearranged, the change in the debt to GDP ratio is delta B over Y equals R minus G divided by 1 plus G times B over Y minus primary surplus over Y. Implication: if R is greater than G, debt tends to explode unless the primary surplus is large enough, a situation often called debt snowball. Lowering the policy rate reduces R, helping debt sustainability, the fiscal monetary spillover. Crowding out effect: when the government borrows heavily, it raises demand for loanable funds, pushing up the market interest rate. Higher I raises R in the debt equation and also makes private investment costlier, reducing private capital formation. Simple is LM illustration. Increase G shifts is right. To keep the money market balanced, LM must shift up, raising I. The higher I reduces I, partially offsetting the fiscal stimulus. Exam-style calculation. Suppose initial debt to GDP equals 60%, R equals 4%, G equals 2%, primary deficit equals 2% of GDP. Find the debt to GDP next year. Delta B over Y equals R minus G divided by 1 plus G times B over Y minus primary deficit. Plugging in numbers, 0.04 minus 0.02 divided by 1.02 times 0.6 minus 0.02 equals 0.0196 times 0.6 minus 0.02 equals 0.0118 minus 0.02 equals negative 0.0082, about negative 0.8%. Debt to GDP falls to about 59.2% despite a primary deficit, because G is low and R minus G is small. If the central bank raises I to 6%, R equals 6%, the term R minus G rises, turning the change positive, illustrating how tighter monetary policy can worsen debt dynamics. Understanding these equations helps managers evaluate the sustainability of public sector financing and anticipate how monetary decisions will affect corporate financing costs.